Business now then. Starting the news, the European Commission has launched an antitrust case against the Russian energy giant Gazprom.
Yeah, this is the latest salvo in the, well, difficult relations, shall we say, between the EU and Gazprom, the Russian energy giant. Of course, back in 2006 and 2009, energy supplies were cut off to a number of southeastern European countries in the middle of winter, which was really a show of force by Gazprom in price disputes back then. The EU has had suspicions that Gazprom is using its dominant market position in some countries to hike prices and force out competitors. And now it has launched a probe into that. Suspicions were apparently raised when Gazprom prices went up in some countries in the middle of the economic crisis, when you'd expect them to go down with falling demand. But relations have, of course, it's not been tricky. It's not just that 2006 episode when gas was cut off. There is also a pipeline being backed by several EU nations which will circumvent Russia and go around Gazprom's monopoly, which has rather annoyed the Russians as well.
OK, and we've got another energy company in trouble as well. This is on the other side of the Atlantic. Yeah,
this is BP, of course. Haven't been very popular in America ever since the Deepwater Horizon oil spill, and that continues to rumble on, the consequences of that. The civil proceedings are getting underway in January, and in a memo filed by the Department of Justice in the run-up to that, they have said, well, that the behaviour, words and actions of BP executives wouldn't be tolerated even in a middling-sized company operating in a suburban mall. And so that is quite a damning condemnation, obviously. They say it certainly shouldn't be tolerated in something as dangerous and complex as deepwater oil drilling. And they have accused BP of gross negligence. That could come with a $21 billion fine.
OK, strong words there. Well, next we're going to go to Greece. Probably some strong words there as well. It's bracing itself for another visit from the troika this week. That's inspectors, of course, from the EU, the IMF and the European Central Bank. Now, the country is still struggling to stay in the Eurozone, but it is a challenge that isn't getting any easier years on from the beginning of the crisis.
Desperate protests outside the front door of Greece's health minister. These Greeks have been left reeling after suddenly being forced to pay for health services that were previously funded by the state.
We have faced all sorts of problems. They cut our pensions, they cut our supplementary pensions, they cut our benefits, they cut our medicines. We can't buy medicines. The situation is tragic. Our lives are in danger.
Greece is currently awaiting the latest instalment of its euro bailout package, but only if government costs are cut further. To oversee the country's progress, inspectors from the troika, the group made up of the EU, IMF and ECB, are due in Athens later in the week. The Greek government's expected to offer them further cuts in pensions, which have already been reduced twice since 2010. Polls across Europe mostly show support for Greece staying in the Eurozone, except in Germany, the country's main bankroller. For French President François Hollande on a visit to Italy, there can be only one solution to the problems: a united Europe.
It is the European Union that has to find solutions for Spain and Greece and move forward to the next step at the end of the year, which will be a closer union of our banking institutions, a deeper link with our economic and monetary institutions.
There are hopes an EU summit in October will offer Greece and other debt-stricken European countries some relief. Meanwhile, the euro debt crisis continues to churn, claiming more victims than it is offering up solutions.
Well, markets in just a moment, but first, one stock in particular getting attention for all the wrong reasons yesterday. What's this, Will?
Yeah, that's Facebook. Of course, it launched at $38 per share just a few months ago, and it's seen quite a tumble since then. Yesterday, it hit a new low. You can see it falling there the last few months, and it hit $17.55, in fact, in Tuesday's trading. It's prompted Mark Zuckerberg, the founder of Facebook, to say he won't sell his shares in the company for at least a year to try and shore up confidence.
I wonder what it will be worth by then. So what about those markets then? How are they performing?
Not so well. They're following Facebook's lead, really. In fact, the Nasdaq, where Facebook is listed, did manage to finish in the green in US trading on Tuesday. But the other two indices there, they have been hit by disappointing figures from a US manufacturing survey pointed to a contraction in the next few months. And that's something that's had a knock-on effect in Asia, particularly among commodities producers. You can see there they are worried about the future for the US, where they get most of their business.
One bit of good news, car sales seem to be bucking the trend in the US.
Yeah, there's certainly in August, there were much better than expected sales figures, in fact, in the US car market. If you take a look here, this is the year-on-year improvement for August. Volkswagen really leading the pack there, quite surprisingly. Their best year since 1973 for August, apparently. Honda and Toyota, of course, Japanese manufacturers, they're really bouncing back from the Japanese tsunami the year before, so that's why they're so high up. And a good performance for the big three as well, as they're known in America, down the bottom there. A few factors. The average car in the States is 11 years old, apparently, so a lot of people do need to upgrade. And while petrol is expensive in the US at the moment, people are looking to invest in more fuel-efficient models. Perhaps why Volkswagen's doing so well right now.
OK, well, now we've also got a celebration for you. This is VW, a new arrival, a new birth.
Yes, the biggest selling car in Europe, in fact. It's been updated. Not a big change on the outside for the new Mark 7 Volkswagen Golf. If you can see it there a bit closer up, then you will see that, in fact, it looks pretty similar to the old model. But underneath, it's a whole new platform, which is quite significant for Volkswagen. It's going to be rolling it out across all its brands underneath the underpinnings for Skodas, Audis, Seats, and, of course, Volkswagen here as well.
OK, didn't know it was #1 seller. You learn something new every day with Will Edwards. Now then, next to a battle between two of France's most prestigious companies, Hermes and LVMH, showing some of the world's most famous luxury brands between them. Now a long-running feud, though, looks set to end in the law courts.
They're two of the big names in the world of French luxury, but behind the upscale handbags is a battle of the brands. Hermes is a family-run business founded over a century and a half ago. In 2010, LVMH bought a 17% stake in the company. By the end of this May, those shares had grown to 22%, and the Hermes family is now fighting to stop what it sees as a takeover by its larger rival. With a focus on craftsmanship and rarity, Hermes has just 340 stores around the world. Its turnover is conservative compared to others in the sector, but is still growing, at 2.8 billion euros last year.
Some brands are driven more by their internal culture and, by their commitment to respecting heritage and savoir-faire, more than external market factors. And other brands are driven by both.
LVMH shows another side of the business, the fashion Leviathan. 4 letters hide 60 brands, from Dior to Louis Vuitton, from leather to champagne. A strategy of aggressive expansion and acquisition means the group is visible almost everywhere. They have more than 3,000 stores across the world, with a turnover of over 23 billion euros. Hermes says there's more to the fight than different visions. They're asking a French court to look into complaints of insider trading, collusion, and price manipulation.
Finally, I need your opinion here. Can McDonald's still be McDonald's without any burgers? Well, Will has got the answer for you if you haven't made your mind up already.
Apparently, yes. They're opening up their first all-vegetarian restaurant in India next year, it's being reported, in Amritsar. That's because there is, of course, a bit of controversy in India over meat. If you're Hindu, it's considered the cow is sacred, so no beef for you. And, of course, Muslims consider pork to be an unclean meat. So no sausages, I suppose, unless they're made of something else other than pork. So McDonald's is charting a course between those two by just going completely vegetarian, avoiding meat altogether. Okay. And actually already in India, their biggest seller is the Makalu Tiki burger, apparently.
It's a bit longer than Big Mac, isn't it?
Yeah, but it does sell a lot better over there. They've only got a few hundred restaurants there for a country of 1 billion people, though, so they are looking to expand, and they're going to see if this is the way to do it.
They should open an Indian version here in Paris. I'd give it a go. You never know. Will Edwards, thank you very much as well with the business. He's back in about an hour and 10, 15 minutes' time, something like that, here on France 24. The latest news, though, with Louise after the break.